Oh, leveraged ETFs. Many investors buy them, hoping to juice up their returns. These ETFs promise you 2 or 3 times the daily returns of a certain benchmark. But wait, there even exists a leveraged ETF that promises you 5 times the daily returns of a NASDAQ 100. Isn't it amazing? But as with everything, there's a price to pay. Leveraged ETFs come with one major warning and lots of fine print. If ignored, you'll be positioning yourself for disappointment. First off, how do leveraged ETFs work? To get their 2 or 3 times daily returns, they use leverage as the name implies. They buy different derivatives such as swaps, futures or options. Derivatives allow you to put little capital and amplify your returns several times. For instance, here's a TQQQ ETF's portfolio. It consists of a bunch of swaps, common stocks and cash. By holding these index swaps, TQQQ leverages its NASDAQ 100 returns to 3 times. Maintaining a constant leverage is not an easy matter. Because the underlying index fluctuates throughout the day, the leverage can get out of the whack. For this reason, leveraged ETFs do daily rebalancing. Let me give you an example. Suppose a leveraged 3 times ETF has 100 million in assets. These assets include derivative swaps that generate 300 million exposure to a certain index. Suppose the index rises by 1%. Such move generates a gain of 3 million for our ETF, or $300 million times 1%. The fund's assets increase to 103 million by the end of the trading day. The total exposure of the fund must always equal to 300% of its assets. For this reason, the fund manager will add 6 million of exposure the next trading day. The reverse is true for declines. This has profound implications. It is true that the daily returns will be close to 3 times, but the long-term performance will never be. In directional markets, the leverage will either balloon the fund's assets or reduce it to nothing. Let's come back again to our leveraged ETF with 100 million in assets. Suppose the underlying index declines by 33%, but then recovers back up with 49.25% increase the next day. What about our leveraged ETF? It plunges to $1 million with 99% decline. Later, the fund increases by 147.75% to 2.5 million. Of course, this is an extreme scenario, but it illustrates the point. In bear markets, leveraged ETFs may be wiped out. It's not a question of if, but rather when. And the reason is very simple. A given decline requires a higher growth rate for a full recovery. As we just saw, the 33% decline required 49% growth for a full recovery of an index. But with leveraged ETFs, it's even more complicated since the leverage plays against it. And the fund may be even almost for sure be liquidated, and leaving investors with nothing. Of course, the opposite is true. In directional bull markets, leveraged ETFs will shine. For instance, consider 5 days of 3% hypothetical growth in the underlying index. This will produce 9% daily gains for the 3 times leveraged ETF. Moreover, the compounding effect will produce even higher cumulative gain of 53.9%. But very often the stock market is range-bound, going just sideways with local ups and downs. And this is the real killer for leveraged ETFs, since the leverage will play against them. For instance, take 2023. S&P 500 was range-bound and only recently recovered to its peak with 0% gain. But the 3 times leveraged ETF showed a cumulative loss of 28% for the same period. The whipsawing is the real danger for leveraged ETFs. Of course, if we zoom out, we see a massive outperformance. So if someone sees this chart, he'll be tempted to go all in. But then another issue pops up. Will you be psychologically prepared to stomach these massive drawdowns? Will you be able to wait it all out? If we casually zoom in or out on the chart, we notice huge underperformance depending on the timing. Of course, there are a few other honorable mentions of issues with these ETFs. First, they tend to have higher expense ratios compared to standard ETFs. And second, they are subject to time decay for their derivatives, also known as derivatives theta. Finally, in certain situations, leveraged ETFs may be getting poor prices for their derivatives. Let's say there is a certain leveraged ETF tracking an esoteric corporate bond index. If there's a very low volume in derivatives, the leveraged ETFs will be paying higher prices for these derivatives, and this will be an additional cost for investors. But again, this all pales in comparison to leverage and compounding effects. Leveraged ETFs are more suitable for professionals making short-term bets on market directions. As for everyone else, it's a very bad idea. Thanks for watching.